Yeah, I mean, I find actually attending real-time, real-life conferences, a really refreshing thing that we can now do again after so many virtual events. It's good to actually be in the room with other people, because I think you gauge the mood of the room and the temperature of the market much better when you're actually seeing people and you're having real-time discussions. So for me, the biggest takeaway was actually being able to sort of gauge the temperature of the market in a much more meaningful way than whenever you're trying to do it from a virtual format. So for me, I felt that there was very much a doing mentality in the room. I think there was definitely a cautious approach. People are watching the market very carefully. We've got some challenging times currently in ahead, whether you're UK focused on the UK, but I think that there seemed to be cautious optimism in the room, and people did have that can do, want to do mentality, which is refreshing. I think if we're looking at the UK regional markets, and particularly, we talked quite a lot about offices. I think there was a general sense that the office market was going through a period of structural change, and there will be winners and losers that will emerge from that transition. It's very much like the structural change that went through retail probably 10 or 15 years ago, insofar as we've had a global event in the pandemic which has changed the way people use and perceive future use of offices to be. And I think there was a feeling that the regional office markets definitely had a future, but it's much more likely to be centered around urban mixed-use regeneration projects where there's real life and vibrance that will encourage people to come back to the office and to come into work for that interaction, not just in the micro environment you get from an office, but being around the corner from bars, cafes, restaurants, leisure opportunities. And I think people are looking at the office in a much broader sense now than simply as a place to come and spend dwell time during their working day. And I think companies understand that if they're going to recruit and retain the best talent, whether that's in London, the regions, or elsewhere, they need to be looking at best in class. And I think the other thing we talked about, ESG, is and will continue to be in driving both occupational choices that tenants make and the demands that they and investors, who ultimately will own the buildings, will place on ESG, because they're all working, whether it's stakeholders of any variety, whether it's landlords or tenants, they're all working to their own typically net zero carbon targets, and ESG is very much at the forefront, and that's shaping the urban environment and how we're likely to occupy office buildings moving forwards, particularly in the regions. I think all of the major regional centres have undergone their own regenerations over the last 15 or 20 years. I think the devolution of local powers and responsibilities to mayors in towns like Manchester, Liverpool, Birmingham has given fresh impetus to those cities in terms of moving their identity forwards and looking at ways in which they can regenerate and attract talent. So I think all of the major commercial centres, regional commercial centres, as I say, Birmingham, Manchester, Liverpool, but also places like Bristol, Leeds, Edinburgh, Glasgow, they all have a real identity, a real heart now. They've got huge student bodies, very good quality Russell Group universities typically, and those students who are sort of spending time in those cities as students, when they graduate, there is less of a pull to go to London now, because these regional cities have really developed a character and a vibe all of their own. And a lot of students want to stay there for their careers as well. So our view would be where you've got an ability to deliver best-in-class assets, new build or refurbishment, of a quality and ESG requirement that tenants and occupiers want, then those are the buildings that will do well. Those are the ones that will flourish. They will access superior rental growth. and will be the sort of buildings that investors want to own going forward. So should see yield stabilization and rising capital values. I think the other side of the coin is that those buildings that don't embrace all of those forward-looking qualities and characteristics are likely to very quickly become obsolete. And with obsolescence, particularly from an ESG perspective, comes potential asset stranding. And we would expect there to be a two-tier market emerging, where institutional demand and pricing stability and growth is achieved for best-in-class exemplar assets, which occupiers want to reside in and landlords want to own, and everything else. And the everything else is unlikely to be institutional, and prices are likely to drift accordingly. And occupiers will pay much lower rents because they're really not the sort of buildings they want to be in. Yeah, I guess you go to these conferences with your own thoughts and preconceived ideas on the market, but the really interesting thing is to always compare those with your peers. And how does everyone else read the market, and where do they see opportunity as well? But the things I would take away from my own thoughts and discussions at the conference, I think debt is a very attractive opportunity at the moment. The traditional lenders, let's call it the high street banks, have really tightened their lending criteria in recent months. And whilst they all have their targets to grow their book, they're very focused on how and where they're going to grow their books. So very narrow channels. And it's creating a huge opportunity in the alternative lending market for new entrants who can perhaps be a little bit more flexible and offer borrowers a little bit more latitude in terms of the sorts of assets they'll back and the sort of business plans they'll support. And we've recently launched a debt team here in the autumn of last year, and we're seeing a lot of investor appetite for debt opportunities, mainly because for an investor, you can sit relatively low down the capital stack with maybe senior debt exposure and maybe a little bit of junior debt, perhaps up to 60, 65%. You can back some really great projects with some really great sponsors, but you can get some great returns. So your risk-adjusted return is really very attractive in this market because there's still a requirement for debt, but there's a significant reduction in the pool of lenders who are prepared to invest into the sector at the moment. Yeah, I think inflation is the elephant in the room, and it's the tiger that must be tamed really for markets to normalize. And pretty much governments around the world are very much focusing on inflation being the principal goal, or reducing inflation being the principal goal of their economic policy at the moment. And that there seems to be a consensus view that continue to rise or increase interest rates until such time as inflation is tamed is the right thing to do. It's the main economic foe, and central governments and bankers around the world are taking it as a priority and the principal target and goal. So what we are starting to see here in the UK, and to a point, or to a degree in other markets, is a slowing down in the rate of inflation that was so evident last year and through the autumn as well. If you look at numbers here in the UK, they've been coming down since peaking in sort of October, November time. And we saw that again in January. And that is encouraging. So there is, I think, a belief that we are towards the top of the interest rate cycle. At 4% here in the UK, there's possibly scope to go up to 4.25%, 4.5%. But if the current trend of inflation continues, hopefully interest rates can then peak, and we can start to see them come the other way as we go into 2024 and beyond, which I think is the trigger a lot of investors are wanting to see to really get back into the market, because there's a huge amount of capital. There's quite a lot of caution still. And until I think we can demonstrate clearly that inflation has been tamed, I think a lot of that capital will continue to be cautious and perhaps sit on the sidelines. Yeah, and I think what we have is a mismatch here in the UK, and I think in a number of Western markets. We have a limited supply of investable stock because we have a finite amount of stock and a limited number of vendors. And we have a huge surfeit of demand of capital wanting to get access into the market. I'd liken it to a tsunami wave crashing on our shores. But the question really on everybody's lips is, well, where's the stock going to come from? So who are the sellers? There may be some people under pressure from their banks to sell, but that's relatively limited at the moment. And it's certainly not widespread across the market. So although there is likely to be some distress, it's likely to be with a small rather than a big D. Nothing of the magnitude of the GFC years of 15 years ago now. And the selling through the autumn of last year after the pensions crisis, well, the urgency of that has now fallen away. Those who needed to sell quickly did sell quickly last autumn. Those who were able to be a bit more patient and defer redemptions are doing so. And several of those investors who put in for redemptions in property funds last autumn are now withdrawing those redemptions because they've seen a lot of pain already and they think the worst is behind us. There is a longer term trend for defined benefit closed pension schemes to come out of property because they don't need the illiquidity, the high returns that the illiquid investing gives them at the moment because they're mostly running a surplus after the pensions crisis last autumn and the rise in gilt yields. So there is pressure, but not immediately to sell. That's likely to be over the next few years. So you've got this huge demand and this real shortfall of viable stock. So almost irrespective of the wider economy and what's going on in terms of inflation, interest rates, that supply-demand dynamic is likely to remain. So we feel that there will be a floor in pricing as we move through this year, and a basis for investors to see hopefully some reasonably positive income and capital growth as we sort of move through the cycle after that. Yeah, so I thought it was a really well-run event. I think that the number of attendees is pretty much spot on because you have a really good selection of investors, managers, other property market participants. So there's a broad enough church of people to get a really good download of views and to compare notes in the market. But it's a good profile of people attending the event in terms of seniority, activity across the market. So I really liked the breakout sessions. I thought they worked really well. I thought the keynote speakers were great for sort of teeing up the conference and getting people talking. But I thought the breakout sessions are very effective because they're done on a scale where it becomes more of a group discussion. So it's not just a chair and a panel. It feels very interactive, and I think people therefore take more out of those breakout sessions because they feel as though that they can be involved in the discussion, the debate. So I think the format's great.